Hello, what's up? Good morning, good afternoon, good evening. It's Tom Toole here with episode number 4 of Tom's Take. We know the Fed raised interest rates last week. Big news all across the economy, all across the country. They raised rates by another quarter of a point, and this is the second time that's happened since December of 2016. So what does that mean for consumers? Not just home buyers and home sellers, but the consumers and people within the monetary markets. So what we know is that if the Fed continues to increase rates based on their rhetoric and their policy they've been pushing over the past year or so, savings accounts are going to yield more money. Over the past few years, since 2008, consumers have struggled to get anything for their money by parking it in a bank. So if the Fed continues what they're doing, interest rates are going to go up, and you're going to get more money just by putting it in a savings account, which is going to be a good thing for a lot of the people out there. The second consideration here and the second result of this action is that for people that are buying big ticket items, so think jumbo mortgages. A jumbo mortgage is above a mortgage amount above $417,000. People that are buying big items and going to be financing them, rates are still low historically. They're not lower than last year, but if you look over the past 50, 60, 70 years, these are some of the lowest rates we've seen since the 1940s. So that shouldn't shy away from demand immediately from the lending markets because rates have, again, maintained historically low. Third, mortgage rates. So what a lot of people don't know is that mortgage rates, they're not determined by what the Fed does. The Fed doesn't set mortgage rates. Instead, they are very closely tied to the 10-year Treasury bill and the yield on that. So when the yield goes up, rates go down, vice versa. So by raising rates, it's going to cause the yield to decline a little bit. And we've already seen mortgage rates climb from this time last year, the beginning of the year. We're talking about late March. Mortgage rates on a 30-year fixed loan were coming in right around 3.75%. This year, they're coming in at, on average, 4.25%. So that's a half of a point jump. What it really means and how it really affects people is with their payment. So on a payment, assuming that we're going to be around the average sale price in our market, which is right around $300,000 in the greater Philadelphia area, that change in rates means it's going to cost buyers on average another $70 a month to carry a home. So we're talking about a little more than $2 a day. So it's not going to be a huge difference. And we've seen with what's been happening in the market with inventory levels, multiple offer situations, buyers competing for properties, those three things alone, what we know is that it's not going to make a difference right now with demand, but if rates continue to go up and a lot of these buyers are ending up finding properties and getting settled, it could have a longer term effect on demand. And what we also know is that it's definitely going to be more costly to buy a home. We've already seen that over the past year. Again, $70 a month isn't a ton of money, but that can be the difference from someone qualifying for a loan and not qualifying based on their debt to income ratio. So we look for this to continue. It's pretty clear that's going to happen. And if you want to follow mortgage rates, follow the 10-year Treasury bill, not what the Fed's doing. Lastly, what does this mean for the economy in general? So President Trump has made promises to return the United States back to about a 4% economic growth per year. The Fed is predicting closer to 2%. And what Trump's been doing is he's been out there talking about building infrastructure within the country. Roads, bridges, all those sort of things. And if he commits to those plans, and that's a big if, we know what happens in Washington, but if he commits to those plans, that's going to increase demand for certain goods. And if demand increases, we could see a little bit of inflation, which we haven't seen in a long time. So that's something to kind of watch out for as we see the rest of 2017 play out, not only with the Fed's monetary policy, but also with the new administration. Questions, concerns, comments, whatever you got, post them on social, comment below. Look forward to talking to you again next week. Thanks for watching.